a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about commodity ETFs. And we know that inflation has been rising, and in fact, some of the recent inflation reports have been much hotter than expected, with inflation rising at highest pace in many decades. So commodities have historically provided some protection against inflation, and they're also contributing to rising inflation. So we will take a look at three most popular commodity ETFs. So we have seen this inflation surge, which is resulting mainly due to supply chain disruptions around the world, which are being made worse by the rapid spreading Omicron variant. And we have also seen that labor shortages are leading to rising wages. And in fact, again, COVID-19 Omicron variant is just making those things worse. That is the reason why inflation has been rising, and we have seen the price rise in commodities across oil, natural gas, food prices, industrial metals, and lately gold prices have also started rising. Now, oil and natural gas, just let me talk a little bit more about them. They are currently trading at highest levels in many years. In fact, energy was the best performing sector last year. It did pretty well because oil prices continued to rise, and they have recently soared because of rising geopolitical tensions. We have seen this build-up of Russian forces across Ukrainian borders, so those geopolitical tensions, and we have also seen that in the Middle East, Yemen's Houthi rebels, they launched some missile attacks on crude facilities in UAE. So those tensions may lead to supply disruptions, and because Middle East and Europe, these are among the big suppliers of crude. And in Europe and Asia, shortage of natural gas has resulted in many power stations to switch from gas to oil. So that is also further exacerbating the oil demand. Finally, talking about gold. So gold underperformed last year, even though historically, gold does well when inflation rises. But we have seen that gold prices have started rising this year, and inflows into gold ETFs have surged. And that is mainly because of these geopolitical tensions that I mentioned, because gold typically is a safe haven asset and does well when geopolitical tensions rise, and it is supposedly a hedge against inflation too. Now, another reason to look at these commodity ETFs is that in addition to inflation hedge, they also provide some diversification benefits in the portfolio. Now, the first one that I'm highlighting is by Invesco. The name is quite long. Invesco Optimum Yield Diversified Commodity Strategy No K1 ETF. Ticker symbol is PDBC. And quickly highlighting the second one too, it is DBC. So DBC used to be the most popular commodity ETF earlier. Then Invesco launched PDBC, which I would say is an improved and cheaper version of DBC. So it holds futures contracts on 14 heavily traded commodities. Now, we have talked about futures investing earlier too, and how that results in roll costs because futures curves are normally in contango. So that means later dated futures are pricier than near dated futures. So whenever the manager of the ETF rolls from expiring ETFs to new next month ETFs, they result in roll costs. So all these ETFs that we are talking about, they try to minimize contango and roll costs by selecting appropriate month futures contracts. PDBC is actively managed. And as we have seen, investors have switched from DBC into PDBC. So now it is the most popular commodity ETF with 5.25 billion in assets. And this is also cheaper with 59 basis points expense ratio compared to DBC. Now, if you want to learn more, you can go to the code page on Zacks.com, read our articles, research reports, and go to the external homepage, Invesco webpage, to see what exactly it holds. So currently it is holding these futures: gasoline, heating oil, Brent crude, WTI crude, aluminum, zinc, copper, gold, then food, soybeans, corn, wheat, sugar, natural gas, then silver too, etc. And you will see a lot of these treasury swaps too. These are for providing collateral for these futures contracts. And then going back to DBC, which I mentioned, this was the earlier most popular, as I said. So the main difference between PDBC and DBC is that PDBC does not issue a K1 form. K1 form used to be a headache for commodity ETF investors. So PDBC has eliminated that headache. So if you want to learn more about DBC, again, you can go to code page on Zacks.com, and from using the link, you can go to Invesco webpage. But these are very similar ETFs, PDBC and DBC. And as I mentioned, the main difference is PDBC is actively managed, cheaper, and does not issue K1. The third one that I'm highlighting is by iShares. It is cheapest of the three. It is the iShares GSCI Commodity Dynamic Roll Strategy ETF. Again, a very long word, COMT. It selects 14 commodities from 6 broad commodity groups, and this also uses a dynamic roll strategy to minimize roll cost and improve performance. And this also does not issue K1 form like PDBC. This has 2.8 billion in assets and the cheapest of the three. Again, to learn more, you can go to the code page on Zacks.com. And from there, you can go to the external homepage, the iShares webpage, to see what this ETF holds. So you will see all those collaterals, and looking at the commodity exposure: energy, agriculture, industrial metals, livestock, and precious metals. These are the top commodities in this ETF. On the last slide, I have the comparative performance versus the S&P 500 index. So the two by Invesco, they are very similar, and as I mentioned, they follow similar strategies. So that is why they are both up the same amount in the past 1 year, about 43%. The iShares product is up about 40%. The S&P 500 is now up just about a little over 16%, and that is mainly because of the recent plunge. Thanks for watching. Make sure to check out Zacks.com/promo for an interesting offer, and also make sure to subscribe to our videos, our video channel, so that you do not miss anything. And I will see you next week.